Imagine waking up tomorrow and realizing that the banks you trust, the ones holding your savings, approving your loans, and shaping your future, may not be as independent as you think. What if global banking is not controlled by thousands of competing institutions, but quietly influenced by a very small circle of powerful players? That idea sounds extreme, maybe even conspiratorial, but by the end of this video, you may see the financial world very differently. Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. Banks are often presented as neutral machines that simply move money around. You deposit, they lend, they earn a spread, and the system keeps running. But history tells a much more complicated story. From the earliest days of money lending, finance has always been about power, influence, and access. The question is not whether banks shape the world, but who shapes the banks themselves. To understand who really controls global banks, we have to go back hundreds of years, long before skyscrapers and trading apps. In medieval Europe, money lending was risky, controversial, and often restricted by religion. Yet trade could not grow without credit. Families who mastered this risky business, like the Medici in Italy, didn't just become rich. They became political kingmakers, quietly deciding who could fund wars, build cities, or rule nations. This pattern repeated itself again and again. As empires expanded, banks followed. The Rothschild family in the 18th and 19th centuries built a network of banking houses across Europe. They moved information faster than governments, financed wars on multiple sides, and influenced national debt markets. Whether myths exaggerate their power or not, one thing is certain: banking influence was already global long before globalization became a buzzword. Fast forward to the early 20th century, and the world faced a new problem. Banking had grown too powerful and too unstable. Financial panics were common, wiping out savings overnight. In the United States, a group of powerful bankers secretly met on Jekyll Island in 1910. Their goal was to design a system that could stabilize banks while protecting their interests. The result was the Federal Reserve. Here is where many people get confused. The Federal Reserve sounds like a government agency, but it is a hybrid system. It is backed by the government, yet owned by member banks. The answer unfolds slowly, and it is not reassuring. Around the world, similar systems emerged. Central banks became the lenders of last resort, able to create money during crises. On paper, this power exists to protect ordinary people from financial collapse. In reality, it often protects the largest institutions first. When things go wrong, small banks fail, while the biggest ones receive emergency support. Over time, this creates a dangerous imbalance. This imbalance exploded into public view during the 2008 global financial crisis. Banks had taken massive risks with complex financial products tied to housing markets. When the system collapsed, trillions of dollars vanished, millions of people lost homes and jobs. Yet many of the same banks responsible for the crash were rescued with taxpayer money. Executives kept bonuses, ordinary people absorbed the pain. Instead of becoming smaller and safer, many global banks became even bigger. Mergers and bailouts concentrated power into fewer hands. The phrase "too big to fail" quietly turned into "too powerful to challenge." So who actually controls these massive institutions today? The answer is not a single person or secret group meeting in a dark room. At the center of this web are a handful of asset management giants. Companies like BlackRock, Vanguard, and State Street manage tens of trillions of dollars in assets. They are not banks in the traditional sense, but they own large stakes in almost every major bank. Because they manage money on behalf of pension funds, retirement accounts, and index funds, their influence is mostly invisible. Yet when they vote shares or engage with executives, boards listen. This creates a strange situation. The same few firms often appear as top shareholders across competing banks. On paper, banks compete fiercely. Behind the scenes, ownership overlaps. This does not mean collusion, but it does mean shared incentives. Stability, predictable profits, and system-wide support become more important than aggressive competition or radical reform. They bought massive amounts of government bonds and even corporate debt. In some countries, central banks indirectly supported stock markets. This blurred the line between market forces and policy decisions. The financial system became dependent on constant support, Here is the cliffhanger most people miss. If central banks cannot allow markets to fall without risking collapse, who is really in control? Is it the banks, the regulators, or the system itself? The uncomfortable answer is that no single actor is fully in charge anymore. Power has become systemic, locked into feedback loops that reward size and punish failure only at the margins. Think about your own life. Your mortgage rate, credit card interest, student loans, and even job security are influenced by these dynamics. When central banks raise or lower rates, they are not just fighting inflation. They are protecting financial stability. Sometimes that means slowing the economy, even if it hurts workers. Sometimes it means supporting asset prices, which mainly benefits the wealthy. History shows this is not new. In the 1920s, easy credit fueled speculation. In the 1970s, inflation eroded savings. In the 1990s, deregulation encouraged risk-taking. Each era ends with a breaking point. Each time, the system promises lessons learned, yet the core structure remains. Technology was supposed to change this. Online banking, fintech apps, and cryptocurrencies promised decentralization. For a moment, it looked like traditional banks might lose control. This brings us to modern global banking. Today, a handful of megabanks dominate international finance. They clear payments, finance trade, and underwrite governments. Their failure would ripple across continents. That gives them leverage, not just over markets, but over policy decisions. You might wonder if governments could simply take control. After all, banks operate under licenses. But governments are deeply dependent on banks to finance deficits, manage debt, and keep economies functioning. This mutual dependence creates a quiet standoff. Neither side can push too hard without risking disaster. As a result, meaningful reform stalls. Consider the repeated pattern. Crisis emerges, public outrage follows, regulations tighten briefly. Over time, rules weaken under pressure to promote growth. It is because the structure rewards short-term stability over long-term resilience. The fallout is subtle but profound. Wealth inequality widens. Asset owners benefit from rising markets supported by policy. Savers struggle with low returns. Younger generations face higher debt and housing costs. These are not accidents. They are outcomes of a system designed to protect financial institutions first. So who really controls global banks? It is not a shadowy cabal, but a concentrated network of capital, policy, and influence. Together, they form a system that is incredibly powerful and incredibly hard to change. The failed fixes matter too. Stress tests, capital requirements, and compliance rules sound reassuring. Smaller banks disappear. Big banks absorb costs more easily. Once again, concentration increases. The system becomes safer on paper and more fragile in reality. This is where the story connects to today's headlines. Rising interest rates, banking stresses, and debt levels are not isolated events. They are symptoms of long-term structural issues. Each policy choice trades one risk for another. Each rescue sets expectations for the next crisis. Now for the question that should keep you watching until the end. If this system is so entrenched, what can individuals actually do? Are we powerless, or is there a way to navigate this reality intelligently? The answer is not dramatic, but it is practical. First, understand that banks are not neutral. They respond to incentives. Knowing this helps you interpret financial news without panic or blind trust. Second, diversification matters, not just in investments, but in income and skills. Systems change slowly, but shocks happen fast. Third, awareness is a form of protection. When you see patterns, you are less likely to be caught off guard. The warning is simple. A system built to avoid collapse at all costs may delay pain, but it often makes the eventual adjustment bigger. History suggests that ignoring this reality leads to harsher outcomes later. The open-ended question is whether future reforms will truly change incentives or simply buy more time. As you think about who really controls global banks, remember this is not just a finance story. It is a story about power, stability, and everyday life. The money system shapes opportunities long before individual choices come into play. Understanding it does not make you cynical, it makes you prepared. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.